Ben Emmons, what is the financial domino effect and how dangerous is it?
Well, the financial domino effect consists out of three effects actually. It's social, political, economic and financial that I describe in the book. And it is indeed very intertwined and perhaps dangerous, if you will, because these effects keep recurring each time that the crisis goes on, for example in the Eurozone, where these three effects have been very evident. And so the financial domino effect is a complex web of effects that keeps reoccurring.
Would the worst case scenario be something like what we saw in 2008 when the financial crisis hit? Because that certainly wasn't pleasant.
Yeah, a scenario like that could repeat itself indeed if you would have further leverage restarting in the financial system, for example, or like what's happening in the Eurozone, banks still have to dramatically deleverage their balance sheets, and if that gets forced again into a sort of a cycle, then that kind of effect may occur. That said, there's of course a policy focus on that sort of event where central banks as well as policy itself has said, like, we don't want a Lehman event anymore. So domino effects, chain reactions are closely watched by policymakers. They respond to that, and hence they will do everything against that to prevent that.
Speaking of central banks, are Ben Bernanke's QE policies helping or hurting the U.S. and the global economy? Because people are talking about a treasury bubble right now.
Yeah, quantitative easing had a big impact on asset markets. So if you're invested in equities and commodities, you've done really well. You've created wealth for yourself. That said, that wealth is not really spilling over into the US economy. In fact, the job creation itself has been very sluggish, not necessarily attributed to that quantitative easing has been applied by the Federal Reserve. What it's done is loosened financial conditions in markets, not necessarily credit conditions in the economy, not yet at least. It's not evident. So it hasn't, I would say, hurt the economy because it did loosen conditions, but it not necessarily generated more economic growth either.
Another potential trouble spot that you discuss in the book is the disintegration of Europe. Now, they recently won the Nobel Peace Prize, the European Union. Is that just a prelude to it breaking up? And what would the effects of Europe breaking up be?
Well, I guess the Nobel Prize for Peace is maybe a good thing, a positive thing, because all these countries, that's the EU 27 by the way, not just the monetary union, they all are being recognized as being a peaceful region. But as we know, the imbalances are large between countries, the political division is large. As we speak, there's a summit again in Brussels taking place. They continue to have divisions about how to form a banking union, how to form a fiscal union. And those political processes take time to really play out. What the risk there is that particularly social-political elements where people on the street start protesting more and more, that has an influence on political spectrum, and that diverges from taking decisions to form a monetary union that could then ultimately lead to a disintegration. I would say that the monetary union, if the breakup were to occur, would really go through the political process.
So how does somebody invest with all these things going on, and not just unrest in Europe, but unrest in the Middle East as well?
Well, the domino effect, as it describes, is a complex web. So what you really are looking for is to distinguish what kind of effects are you dealing with. If it's socio-political, the outcome may be a revolution or war type event, something extreme. If it's economic, it could be a multiplier effect, a recession or a sharp recovery. And if it's financial, it may be indeed a financial crisis. So in these three sort of extremer outcomes, how would you position yourself as more like an appropriate hedge in terms of to insure yourself? So in the case of war, you will be more inclined to tangible assets, cash, T-bills, gold. If it's like an economic multiplier effect, probably equities and corporate bonds will do better as the recovery takes place. If it's a financial crisis type of event, probably treasury bonds, German bunds, liquid government bonds will be the better appropriate insurance in the portfolio that you have. And as you take all these effects together and we maintain this sort of situation in markets where risk on, risk off happens every day, I almost, per definition, have to hold some form of insurance in your portfolio guarding against all these effects.